Welcome all. So, now we will learn about the different approaches to calculate the cost of equity. The one important source of finance, we call it as generally the internal source of finance for financing the investment projects or the investment proposals by the firms. So, out of the two broad sources, internal and external sources, equity capital is the main internal source, because preference capital provides the say only a fractional amount. A larger part of the finance comes from the equity capital. In case of any form of the business organizations, I would share with you that whether it is a sole proprietorship or a partnership firm or even a private limited company and public limited company, larger component has to come from the internal sources, because first if the owner is ready to make investment in the business, then only the outsiders will believe or the outsiders will trust the business. But if the owner is not investing anything from the pocket and largely depending upon the external sources, that does not happen, right. So, certainly more in case of the sole proprietorship, more funds come from the internal sources, internal equity is very high. In case of the partnership firms, yes, the internal funds are very high, and private limited companies largely more funds come from the internal sources. Once the efficacy of the internal funds is proved, then the external sources or maybe the borrowing from the external sources will be allowed, or will be they will be inclined to make investment in any company, otherwise not. And same is the case with the public limited companies, that normally we call it as that debt equity ratio is 2:1. Standard debt equity ratio is the 2:1 in the say capital structure ratios. So, what does it mean? That if we invest minimum 1 rupee from our own pocket, then we can borrow 2 rupees from the market, right. So, minimum investment has to come, or sometime it becomes maximum investment also if the say overall profitability profile is not up to the mark or the volatility of the earnings is very high, then sometimes what happens, more funds come from the internal sources, which we call it as the equity capital. So, as I told you in the previous class, that because of the non-fixed nature of the dividend, which is the return on the equity paid to the equity shareholders or investors into the equity shares, because that is not fixed, that is uncertain, sometime it is more, sometime it is less, sometime it is 0. So, it makes very difficult for us to calculate the cost of equity. So, I told you that we have the 4 approaches here. One is the CAPM approach, capital asset pricing model approach. Then is we have the dividend, bond yield plus risk premium approach. Then it is the dividend growth model, which is given to by the Gordon, Professor Gordon, and then it is we have the 4th approach is the earnings price ratio approach. So, if you look at these 4 approaches, the major difference is only first approach here it is, this is the most objective approach, security market line approach, whereas the other 3 approaches to some extent or maybe to a significant extent, they involve the element of subjectivity. And when the element of subjectivity comes, then sometimes trusting that particular method or component becomes say difficult, or that estimate becomes doubtful, that what is the say you can call it as the acceptability of those subjective estimates, that is a $1,000,000 question, right. So, let us discuss these approaches one by one, and then we will say conclude which one is going to be the best one, which normally firms use in practice in the market. And even as a new entrepreneur or any manager of any or any financial manager of any company, we should suggest to the company that which approach is more means say prone to use or likely to use or going to give us the best results. So, first is the security market line approach. Security market line approach is basically, you call it, as I told you, that it is based upon something which is called as the capital asset pricing model. Capital asset pricing model, and the capital asset pricing model, CAPM model, is this model basically. You call it as the equation of the CAPM is this one, and with the help of this model you can calculate the cost of equity. So, here what it is included in this model, RE, that is on the left hand side, cost of equity or the rate of return on the equity, right. But how to calculate that depends upon the components in the right hand side, which is RF plus beta E into ERM minus RF. right. So, what is this RF? Let us see all these components one by one, they are given here. So, it means now if you want to see that RE is basically the required return on equity of the company, and RF is basically the risk free rate. Risk free rate is that rate on which the element of risk is almost negligible. You can assume that if you are making investment into any say avenue of investment where the rate of return being provided is a risk free rate. So, it means you can assume that at the end of that investment period or investment horizon, that much of the return will be certainly available from that investment avenue. For example, you talk about the investment into the government securities, government bonds. Government issue two kinds of the bonds, treasury bonds which are the short term investment instruments, and the long term bonds which are long term investment instruments, and whatever the rate of interest government promises, that is normally paid on the maturity. That is why they are called as the gilt edged securities, because the element of the security associated to those bonds is called as the gilt edged securities. So, gilt edged securities are going to give us the certain return which is the promised return, and at the end of that maturity period, come what may, that much of the return is available. Simply talk about the bank rate. When we give our funds to banks or we make our investment in the bank in the form of the fixed deposits or maybe in case of the recurring deposits. So, whatever the say rate of return banks promises to us, it is a gilt edged deposit, it is a gilt edged security, and that much of the return is available from the bank. So, that rate of interest is called as, or that rate of return is called as the risk free rate. This is called as RF, plus beta of equity, right, beta of the stock, individual stock I am talking about, because we are going to talk about the cost of individual security. We are not going to talk about the say cost of the entire market stocks. So, individual security means it is called as the beta of the individual security, and with the beta you are multiplying the difference between the expected market return minus risk free rate, expected market returns minus risk free rate. So, beta is basically the beta of the equity of the company, beta of the equity of the company is the beta E. Now, what is beta? How would you define beta? Beta is basically the measure of riskiness of an individual security as against the riskiness of the whole market. Element of the risk involved in the risk of an say individual security or the stock of an individual company as against the market in the risk the element of the risk in the market as a whole. So, this is a relationship which is exhibited by beta. For example, you say the beta is 1, beta value is 1, it ranges from 1 to say more than 1 or sometime less than 1. So, for example, the beta 1 means the security of the company or the stock of the company is as much as risky as there is a total market risk. It means what is the average market risk is there, the security of this company is also that much risky, and the individual security is not less risky or more risky as compared to the market risk. So, beta explains about the relationship of the risk between the individual security and the market risk, or the risk in the individual security and the market risk. For example, beta is 1.2, right. So, you can say that individual company whose stocks you are going to evaluate or the cost of the equity you are going to calculate is riskier as against the total say average risk available in the market, because beta is 1.2, but for example beta is 0.8. So, in that case you can say the security of the company, the stock of the company in question of which the cost we are going to calculate is less riskier as compared to the total market risk. It means if you calculate the total risk in the market of all the securities being traded in the stock exchange, they are more risky, average risk of all those securities is more as compared to the risk associated with the individual security. So, beta is basically the indicator of the risk associated to the individual security as against the market risk. Expected ERM is basically expected return on the market portfolio, expected return on the market portfolio. That total market return is how much, because this is the difference, and this is a difference is basically why, because if you want to have the risk free rate of return, then why should you go to stock market? you should not go to stock market then. It means that much of the return is available from the government say bonds, short term or the long term depending upon the investment horizon, it is available in the bank deposits. So, if we are going out in search of the higher rate of interest or the higher rate of return, that is why we are into the stock market. And when you are expecting the higher rate of return, by going to the stock market, you are prone to the higher amount of the risk also. So, this basically you call it as the risk premium. Expected market return minus interest risk free rate of return is the reward for that particular risk which the person, the investor is going to take by investing his surplus savings not in the risk free rate of return, but in the stock market. So, he is ready to take the higher amount of risk, and for that he needs to be compensated by the higher amount of return. So, expected market return means expected return from that security minus in the market minus risk free rate of return is called as the ERM. Basically, it is talking about the risk premium, that is ERM minus RF is basically the risk premium, which will largely depend upon the element of the risk associated to that security. If the element of risk associated to that individual security is high, then the risk this premium will be affected accordingly, and if the risk or the beta is low, then certainly the risk will be much less, as because the individual security is less risky as against the market risk. So, we are multiplying the say the risk premium, that is the ERM with the RF with the beta, and ultimately we are going to decide about the riskiness of the security by taking into consideration or calculating the beta, or beta in the same way you call it as basically the variance of the return available from the companies or the investment in the company's stocks. Now, for example, we have taken a simple illustration here. RF, we are assuming risk free rate of return is 7%, beta of the security is 1.2. 1.2 means security is 20% riskier as compared to the market risk, average market risk. This security in question of this company is 20% more risky as compared to the general market risk, and ERM is expected market return available in the stock market is 15%. And RE, if you want to calculate by using this, then it works out as 16.6%. This security is going to give you the higher returns as against the market returns by 1.6%, because beta is higher, because riskiness of the security is higher. So, the volatility is higher, volatility of the return in this security is higher, but since you are going to take the more amount of risk, that is why the return also is higher as compared to the market return, because risk and return are directly correlated. So, in this case you can easily calculate the cost of equity, that is basically the required return on the equity of the company. RE can be calculated by taking into consideration the risk free rate of return, beta of the security, and the risk premium which is available, and that can be calculated by say subtracting the risk free rate of return from the market return, and RE is equal to 16.6% in this case. Now, for calculating this model, or means using this model or calculating the cost under this model, the cost of equity under this model, we need certain inputs, and from where the inputs come, that is we are going to talk about in this slide or this particular say presentation here. Different inputs can come from the different sources, or different estimates are there, and there is a complete disagreement in the market between the among us the financial practitioners, but important means finally we arrive at the best estimates which are acceptable to all. So, despite the significant disagreement existing in the market among us the finance practitioners, there are some common points which are of the quite helpful or reasonable help, and if we follow these points, then certainly we can find out all the input variables required for the security line model or the CAPM model, right. So, first thing is the risk free rate may be estimated as the yield on the long term bonds that have a maturity of 10 years or more. Means the question here is that when you are talking about the risk free rate of return, this 7%, from where this has come? Why should you take it as a 7%? Currently, for example, it is 6.25%, right, and previously it was maybe sometime 8%. In the future also it is expected, it may go up or it may come down. So, how can you say that risk free rate of return is always 7%. How to arrive at this risk free rate of return? This is the point regarding this, that the risk free rate may be estimated as the yield on long term bonds that have a maturity period of 10 years or more. So, you can calculate the average of this, the yield on the long term bond for the period of 10 years, so that if you predict about the next year on the basis of the yield on any bond for the period of the past 10 years. So, it means largely you have adjusted for all ups and downs, and you can say that whatever we are expecting the rate of interest for the coming year will be rightly anticipated, or will be able to calculate it correctly. Second point is the market risk premium may be estimated as the difference between the average return on the market portfolio and the average risk free rate over the past 10 to 30 years. You can find out, because market portfolio is easily available. For example, you can take the Sensex value, right, how the Sensex is changing. So, market index is easily available. You have the different indices are there, different market indices are there, and for say you can take the Sensex value, you can take the Nifty value. So, that can be considered as the representative of the market return, and for the individual security or for calculating the say risk free rate of return, you can take the say average risk free rate over the past 10 to 30 years. So, you have to subtract from the market return the risk free rate of return, and the time period is so large, 10 to 30 years we are talking about. So, that difference between the market return can be say used, means the market index can be used as the proxy of the market return, and the risk free rate can be used from the say long term bonds for a period of the past 10 to 30 years, maybe 10 years, 15 years or 20 years, or maybe 30 years also, depending upon the information available. So, if you are taking such a long period and you are getting two proxies easily available, the market index as well as the say the risk free rate of return, so premium can be satisfactorily worked out. The beta of the stock may be calculated by regressing the monthly returns on the stock over the monthly returns on the market index over the past 60 months or so. It is basically the regression equation, means if the market return is this much, how much will be the return from the individual security. So, it is basically the regression analysis we do it by calculated by regressing the monthly returns on the stock individual security, whose cost we are going to calculate over the monthly returns on the market index over the past 60 months or so. And next thing we talk about the systematic risk and the unsystematic risk. These two risks are very important risks to be taken care of. As far as the say unsystematic risk is concerned, unsystematic risk is basically the company level risk, you call it as the company level risk, which can be largely taken care of with the help of diversification of the investment, right. Say for example, if we are investing into the stocks, maybe we have the as an individual also or as an institution, if we have to invest the certain sum of money, it is always advisable that do not put all your eggs into one basket. So, what should we do? For example, if somebody want to make investment of 100,000 rupees into the stocks or in the stock market, he should choose a different securities. He should make a good portfolio of the 3-4 securities, 3-4 stocks of the 3-4 companies, so that if the stock of any company or the return on the stock of any company goes up and on the other goes down, so ultimately net results remain the same, he has not lost anything. And if the proportion of the growth and the proportion of decline is equally same, so at least you are at the state of the no profit no loss. Or sometimes if the proportion of the growth is high and the proportion of decline in the other securities lesser, ultimately you end up making some profits. So, with the help of, I mean to say, diversification, the unsystematic, the company level risk can be taken care of. But the other risk, which you call it as the systemic risk, and the risk which you say may come because of the industry risk or the market risk. So, we have the three kind of the analysis, EIC analysis we call it as. We call it as the say EIC analysis. EIC analysis means this is EIC analysis. It is economy, it is industry and it is company. As far as the company level of the risk is concerned, by analyzing the company's stocks over a number of years, the product type, the company's background, you can easily take care of that what is the riskiness involved. So, with the help of diversification, this risk, which is called as largely the unsystematic risk, can be taken care of. And for taking care of the systematic risk, you have to then use the different strategies. And for say this systematic risk means, because largely the market premium depends upon expected return from the market, depends upon the systematic risk, and for that systematic risk we have to now say the different things say given here, and for that what you have to do is you have to calculate the beta. Because individual security, the risk associated you have already nullified by going for diversification. Systematic risk, which is represented by beta, needs to be taken care of because it comes from the factors which are beyond the control of any individual, any company also. They are caused by the industry as a whole, they are caused by the economy as a whole, economic system, industrial situation, recessionary situations, inflation rates in the market, or maybe the demand and supply situation, world economic scenario. So, all these factors which are going to create the problems and going to affect the returns of the stocks of individual companies, which is calculated in the form of the beta. We have to now say calculate the beta, and with the help of beta you can try to find out if the amount of the beta is high, then certainly we want the higher premium for the compensation against the systematic risk. So, with the help of beta the systematic risk can be measured, and for handling of the unsystematic risk we can use the concept of diversification, and people can use both, means the prediction of this systematic and the unsystematic risk involved in the riskiness of the security. And if you look at the model, we have taken care of both the things, that if you want to increase the return from the market, the return into the individual security, then you talk about the unsystematic risk. So, there we use a diversification, and for the systematic risk you can use the beta, and with the help of beta you can understand how much riskiness is there or how risky the security is, and depending upon that you can say assign the premium expected from that investment, and finally we can decide the cost of capital by applying this model of the CAPM. There are some limitations in the CAPM also, that for example the beta of the individual companies do not remain same over the number of years, that can be the one important reason. Even sometimes the unsystematic risk is not also completely possible to be reduced by simply diversification. So, we need some premium for unsystematic risk also. So, despite all these limitations, 80% of the companies in the world use this method, this model for calculating the cost of equity. Despite the beta is not going to remain stable, which is a reflector of the systematic risk, despite the fact that unsystematic risk cannot be fully handled by the diversification, still this model is most objective and most useful model, and you call it as because of the element of objectivity associated in this model, largely the companies in the world use this model for calculating the cost of equity, right. So, this is the most objective technique, and you have understood how to calculate the cost of equity, that is by using the equation or the model given, that is the cost of equity is equal to, that depend upon this, RE is equal to RF plus beta of the individual security into expected market return minus risk free rate, and this is basically the risk premium associated for taking the risk while going to the stock market. So, it means if we are taking the additional risk, we need the additional premium also for getting compensated for the risk we are taking. So, this can be measured by using this model, which is largely called as the security market line approach, which depends upon the model called as the capital asset pricing model, CAPM, given to us by the Nobel laureate William Sharpe. Now, we go to the next approach, which is quite subjective approach, bond yield plus risk premium approach. Bond yield plus risk premium approach, and the cost of equity can be calculated with the help of this approach. So, if you want to use this approach, what we do here is, as this formula says, cost of equity can be calculated with the help of yield on the long term bonds, yield on the long term bonds plus risk premium, plus risk premium. So, yield on the long term bonds of the firm plus risk premium. So, yield on the long term bonds can easily be calculated, you call it as a risk free rate of return, right, which is being used in the security market line approach also, that is RF, that is the yield on the long term bonds, right, that is easily available from the market since it is a risk free rate of return. So, with certainty you can say this much of the return is available, plus because we are going to stock market for making investment into the equity of the companies. So, we are going to take additional risk. So, we need to be compensated by the risk premium for the risk we are taking, and here this factor of the risk under this approach is say added to the say risk free rate of return on the basis of subjectivity or experiences of the market experts. So, should the risk premium be 2%, 4% or n%? How much should it be? 2%, 4%, n%, how much we should add here, because that will depend upon the risk in the market and how much risk is going to be there in the market. For example, if the economy is growing at a very faster rate and our growth rate is very high, Sensex is growing, Nifty is also growing, all the companies are stocks are doing very well in the market return is very high. So, in that case the risk is very low, but the situation can be reverse also, situation can be in between also, it can be means volatile also, right. So, what percentage we should add here? There is no standard formula, no standard mathematical model or approach, only subjective approach depending upon the past experiences and the understanding of the financial experts in the market. You can add some say premium here, and there is, it is written clearly written here, there seems to be no objective way of determining it. In practice it normally ranges between 2 and 6%. In practice normally depending upon, because what has been seen in the market practically, it ranges between 2 and 6% depending upon the operating and the financial risk of the business, depending upon the operating and the financial risk of the business. If the operating and financial risk of the business is high, then we assign high amount of premium, but if these two risks are lesser or lower, then minimum premium which has to be added in the risk free rate of return is 2%. For example, risk free rate of return is 7%, then the cost of equity will be adding 2% is 9%, or maximum it can go up to 13% if it is 6% premium we are adding, right. But that depends upon the riskiness of the individual company and their stocks. So, operating and the financial structure or the risk associated, which is called as the operating and the financial risk, are going to play the part, but the limitation of this approach is that risk premium to be added here has to be based upon the subjectivity and largely upon the estimates, best estimates of the financial experts. Though we are going to supplement this information with the operating and the financial structure of the firm or the operating and the financial risk associated with that security, but still this approach remains largely subjective approach. Next is the dividend growth model, which is given to us by Gordon. There is one you can call it as a mathematician or no, means a person, you call it as a person, not mathematician, I would correct myself. He is the Myron J. Gordon, he is a financial expert. So, Professor Gordon, he is basically the say professor of financial economics. So, Professor Gordon has given this model, and this model is basically called as say how it is explained, it is given here, and this model is called as the dividend growth model. And Gordon says that cost of equity largely depends upon the growth rate of the dividend, largely depends upon the growth rate of the dividend, that at what rate the dividend of the company grows, that is going to decide the cost of the capital of the company. So, here it is written clearly, that is the price of equity stocks depends ultimately on the dividend expected from it. Higher the amount of a dividend, higher the price you are ready to pay, lesser the amount of dividend, lower the price you are going to pay for the stock of that particular company. And if the dividend per share grows at a constant rate of g%, right. So, it means this is again a bone of contention, constant rate of growth which is called as g%, right. So, it means you have to now find out that constant rate of growth. So, this is the major limitation of this model, that can you expect that the dividend will be growing at a constant rate over a period of time? It is very important. We will be having the say the question of this constant rate of growth. We can try to find out how to find out the handler to find out g, that is also discussed in the next slide. But for example, if you assume that this model will be followed for calculating the cost of equity, then this model says that depending upon the dividend being paid on the investment, the cost of equity can be decided. And in this case, how it is being done, P0 depends upon D1, dividend given in any year, divided by RE minus the say G, that is what is the cost of the return from the equity minus growth rate, right. So, it means this dividend will depend upon, that is the return on the equity minus G, this is the growth rate. So, it means for calculating the RE will depend upon what? That is, RE is basically the return from the security or the say rate of return of the security. So, in this case, if we talk about the expected return from the security, it will depend upon how you calculate it, D1 divided by P0 multiply plus G. P0 is the say price of the security in the current year, P0 is the price of that stock in the current year, D1 is the dividend expected at the end of the year, and plus the growth rate is the G. So, here it is the growth rate here, that at what rate the dividend is growing over the number of years, the price in the current year and the dividend in the current year, and plus at what rate the dividend is expected to grow. With the help of that, you are going to decide this value of RE. So, from this rate of return from the equity RE, if you subtract the G and say this dividend is divided by the RE minus G, then you will be able to find out the price of the stock or the price of the equity capital or the equity stock. So, in this case, thus the expected return of equity shareholders, which in equilibrium is also required return, is equal to the dividend plus the expected growth rate, right. So, the expected, this basically when you are talking about this RE, this is the expected return of the equity shareholders, and this expected return of the equity shareholders will depend upon what? This depend upon which is equal to the dividend, which is equal to the dividend plus the expected growth rate. So, it means at what rate the dividend of the this say company is growing in the subsequent years, P0 will depend upon this. So, P0 is largely depending upon what? This is depending upon the dividend being paid on that stock by the company, and that will depend upon the growth rate over the number of years. So, it is written clearly here, if the dividend per share grows at the constant rate of G, then the cost of equity, that is P0, price of the share can be equity share can be calculated by this model, and this largely depends upon the growth of the dividend. Now, the $1,000,000 question here is how to calculate G, how to calculate G getting a handler over G. This is the question, because growth rate, at what rate the dividend will grow, we have to find it out. So, first thing is written here, for publicly traded companies it is easy to determine the dividend yield, however it is difficult to estimate G, right. So, in this case, because for the private limited company it is very difficult, but because cost of equity problem comes normally in case of the public limited companies, there also we have to calculate the cost of equity. So, the dividend is easily available, right, is easily available, that it is easy to determine the dividend yield, however it is difficult to estimate G. So, for estimating G, what we have to do is, number 1, relying on the analyst's forecast of the growth rate. Different companies, different secondary estimates are available in the market from the different research agencies who keep on forecasting depending upon the previous number of years, 10-15 years, they predict that what will be the growth rate of the dividend in case of the different stocks. So, we can make use of that. Average annual growth rate in the preceding 5 to 10 years can also be used, right. If we do not want to depend upon any secondary estimates, then we can calculate it ourselves. Retention growth rate, that is the retention rate, means we can easily try to find out with the help of the retention growth rate also, which can be calculated by retention rate into the return on equity. Retention rate and the return on equity, it can also be done like that. So, it means if you want to follow that, if you want to use the retention growth rate, how can you calculate the retention growth rate? Retention growth rate can be calculated easily by say retention rate is basically, how can you calculate the retention ratio? that depends upon the dividend payout ratio, right. So, if you want to see the dividend payout ratio, so it means a retention rate. How to calculate the retention rate? That depends upon the say 1 minus dividend payout ratio. That depends upon the dividend 1 minus dividend payout ratio, that depends upon the retention rate, right. So, in this case, for example, the dividend payout ratio is 40%, that 40% of the profit is being paid. So, it means your retention rate is going to be how much? 60%, right. So, retention rate is going to be 60%, and if you want to find out the say retention rate is 60% and the return on equity is for example 15%, this is 15%. In that case, sorry, we will have not to use here the this percentage, because we are using it otherwise in the fractional form. So, you have to call it as this particular part, that is 0.6 into 15%. So, if you call it as, so what is the say G will be 9% here. So, you can use the retention rate also. With the help of the retention rate, you can calculate the G. Either you depend upon the analyst or the secondary say sources in the market, or we can calculate G ourselves by taking the growth rate for the preceding 5 to 10 years, or we can use the retention growth rate, which is basically the retention rate into return on equity, right. How to calculate, I have explained it to you. And the companies that do not pay the dividends, or the companies that are not listed in the market, dividend growth rate is not sure. So, return on equity is also not sure. So, there comes the problem. So, it means here we are going to talk about is that in case of the listed companies in the market, either you use the analyst's forecast, or you use the annual growth rate, or you use the retention growth rate. Either way the G can be calculated, and if you are able to calculate G, so it means if the dividend per share means say the cost of capital will be calculated as the price of equity stock depends upon ultimately on the dividend expected from it, and if the dividend per share grows at the constant rate of G, then the cost can be calculated this way. So, for calculating G, 3 estimates can be used. Problem only comes in case of the companies which are not listed in the market. For example, the companies, they are not listed in the market, or sometimes the companies who do not pay dividend, the companies listed in the market, but they are not paying dividend, then there comes the problem. So, there means cost cannot be easily found out. So, there we have to be very careful because growth rate will not be possible to be known, and the return also will not be possible to be known, but the companies which are listed in the market, or which are whose shares are being traded in the market, in those companies cases finding out the cost of capital will not be difficult by following this method, that is called as the dividend growth model given to us by the say financial economics expert Professor Myron J. Gordon. So, this model can be used, which is called as the dividend growth model or dividend growth approach. So, these two approaches, which are called as the subjective approaches, we have discussed apart from the say your this CAPM approach, which is the most objective approach, and last approach I am going to discuss here quickly in the say next 2 minutes is earning price ratio approach, right. Earning price ratio approach is the, with the help of this you can calculate the cost of equity, that with the help of this particular model, that is E1 divided by P0. E1 divided by P0, E1 is the expected earning per share. So, it means earning price ratio approach, earning to price ratio approach, it means what is the base price in the current year and what is the earning expected. By on the basis of that you use this say ratio, and with the help of this ratio the cost of equity can be calculated, where E1 is expected earning per share for the next year, and you can easily calculate the earning per share for the next year is current earning per share into 1 plus growth rate of earning per share. Again now the problem will come for assessing the growth rate, but depending upon the past number of years growth rates we can estimate this also, and P0 here is the current market price. So, current market price has will be dividing the expected return, which can be calculated on the basis of the current earnings per share into 1 plus growth rate of the earning per share. So, with the help of this model you can calculate. This approach is called as the earning price ratio approach. So, you can use this also. This is the third approach, subjective approach, third. In total it is a fourth approach. And point of caution here it is, if you look at this line, point of caution here is this approach provides an accurate measure in the following two cases. Number 1, when the EPS is constant and the dividend payout ratio is 100%, which is quite unlikely in the market. Second is when the retained earnings earn a rate of return equal to the cost of equity, that is the rate expected by the shareholders. When retained earnings earn a rate of return equal to the cost of equity, that is the rate expected by the shareholders. So, in these two situations, if these two situations are held good, then means when the dividend payout ratio is 100%, whatever the profit we are earning we are distributing as dividend, which is quite unlikely. And second thing is retained earnings earn the same rate as expected by the equity shareholders, or which is equal to the cost of the capital, which is also again going to be very difficult. So, since these two say conditions do not hold good in case of this say application of this approach. So, this approach is not used in say practical sense. So, in case of the subjective approaches, either you use the second approach, or you use the third approach. Means second approach is basically the bond yield plus risk premium approach. There if you know this risk premium you can easily apply, because the first part is stable, we can easily find out which is a risk free rate of return. Whereas in this case if you look at the risk premium, you can, if you are able to find out the risk premium easily, then we can easily use this model, which is again a subjective approach but still usable. Or we can use, if you know the growth rate of the dividend over the number of years, then the dividend growth model can be used, but earning to price ratio approach is not possible to be used. So, as I told you, 80% of the companies use the CAPM, the security market line approach, which is most objective for calculating the cost of equity. But if other approaches have to be used, then you can use either the bond yield plus risk premium approach or the dividend growth model or approach given to us by the Gordon. So, these two approaches can be used, or the most objective CAPM can be used. So, means because of the dividend problem or the dividend issue, this calculation of the cost of equity becomes complex, but ultimately we have to calculate it because we want to calculate the weighted average cost of capital. So, till now what I could discuss with you is that how to calculate the cost of capital of the different sources. First we discussed the cost of capital of the borrowed capital, that is a debt, then the preference capital, and then the cost of equity by following the or by using either of the four approaches. In these approaches, one is the most objective approach and three are the subjective approaches. So, depending upon the resources available and the information available, any of these four approaches can be used. So, this is how we calculate the cost of say you can call it as the cost of individual sources of the capital. But now next part will be that how to decide the proportions, and then on the basis of these proportions how to calculate the WACC, weighted average cost of capital, and how to deal with the problem of the flotation cost. That all I will be talking to you, but in the say subsequent classes, in the next classes. So, in the next class we will learn about how to determine the different proportions, that is largely means dealing with the problem of the capital structure, and then say the flotation cost, and then finally calculating the weighted average cost of capital, that I will discuss with you in the next subsequent classes. Till then, thank you very much.